Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the gold, silver, and copper markets for Monday, May 2nd. Starting off here with a weekly log scale chart of the gold contract, you can see the dominance of the secular bull trend. And because of the magnitude of this major bull trend, and despite extraordinarily high levels of bullish sentiment, moving to a 4-hourly chart of the June contract shown here, the extent of overnight's somewhat excitement and volatility can only be considered at this phase as merely corrective within the broader bull trend. For even on a short-term intraday scale, the market is yet to fail below a recent corrective low that we define most tightly at last Thursday's corrective low at 1524.5. This is the shortest term and tightest risk parameter, the shortest term corrective low and tightest risk parameter this market is minimally required to fail below to even defer the major bull trend, let alone threaten it. And from a longer term perspective, we're pinpointing the 1492 corrective low from last Tuesday. Looking here at a daily log scale chart, the significance of that 1492, that's the latest corrective low on this larger degree scale, sufficient to threaten the broader bull trend if that corrective low is violated. In lieu of such, you can even make a case that the portion of the resumed secular bull trend from the late March low at 1410 is even extending. The prospect of an extended third wave of just the resumption of the secular bull trend from the March low at 1380. So there's still plenty of reasons to believe that the secular bull trend is well intact, and that intra-day and intra-week sell-off attempts like we've had overnight are merely corrective within the major bull trend. In sum, a bullish policy remains advised with weakness below at least 1524.5 and preferably 1492 required to defer or threaten this bullish policy and exposure. Moving to the July silver contract, you can see overnight's break below last week's 44.61 low. That certainly from a short-term perspective has defined last week's resistance in general around the 49 handle area and the 49.82 high from April 25th specifically as an objective short-term risk parameter the market is now required to recover above to reinstate the secular bull trend. But given the scope and magnitude of the major bull trend shown in the daily log scale chart here, we are requiring resumed proof of weakness below the 42.20 low overnight to expose a larger degree correction or reversal lower. Moving here to a weekly log scale chart, you can see the magnitude and dominance of the secular bull trend. That's going to take quite a bit of technical and fundamental work to expose some kind of broader reversal lower. We certainly have the extraordinarily high levels of bullish sentiment that are typical of major peaks and peak and reversal environments. But given the magnitude of this major bull trend, we need to require this market to satisfy 3 reversal requirements before moving from a continued bullish policy. Those being a confirmed bearish divergence in momentum, and we feel at this point that's going to take prices below, or require prices below at least 42.20. We need proof of impulsive trendy behavior to the downside, and most importantly, proof of labored 3-wave corrective behavior on a subsequent recovery attempt to satisfy the 3 reversal requirements in order to move from a bullish policy to a bearish policy. These issues considered, short-term traders are have been advised to neutralize bullish exposure on a failure below the 44.61 low from early last week, moving them to a neutral sideline position and requiring proof of strength above 49.82 to resurrect the secular bull trend. From a longer term perspective, however, long-term traders remain advised to maintain a bullish policy with a break below the 42.20 low from overnight required to expose enough of a threat to the secular bull trend to warrant moving to a neutral to sideline position in order to circumvent the depths unknown of a larger degree correction of the January through April rally, if not a larger degree reversal lower. And finally, moving to the July copper contract, you can see late last week's and overnight's price action break below the 419.20 low from April 18th. That confirms at least the intermediate term trend as down, And you can see on this 4-hourly chart former support areas between 419 and 422 that now if the market is much more vulnerable to further and possibly even accelerated weakness, we would expect this former 419 to 422 area to hold as new resistance in general, and defining a short-term risk parameter specifically at 424.40 that we believe this market is now required to recover above to arrest this sell-off and define it or increase the odds that it is merely part of a larger degree bull market correction dating back to that February 15th high at 464.95. You can see the market's current position at the lower recesses of the past 2.5 months range that we must be particularly watchful for any kind of bullish divergence in short-term momentum to not only reinforce this broader bull market consolidation pattern, but also provide an acute risk-reward buying opportunity ahead of a resumption of the secular bull trend and new highs above 465. You can also see the importance of the 407.60 low from March 15th that we've discussed in a number of our technical blogs and webcasts as absolutely pivotal, the break of which could expose not only a larger degree correction, but quite possibly a major reversal lower that could see further accelerated and even relentless losses straight away. Looking here at a weekly log scale chart and some matters that we have discussed over the past couple of months, the prospect that this 464.95 high from middle of February could be not the third wave, but the completing fifth wave of a 5-wave Elliott wave sequence dating back to the June 10 low at 272. You also have a confirmation of bearish divergence in momentum that has not been negated yet by new highs above that 464.95 high. And also what was at the time historically high measures or levels of bullish sentiment that all contribute to an arguable major peak and reversal threat. Within the context of the broader bull trend and by virtue of the March-April recovery attempt, our technical bias from a long-term perspective has shifted towards all this price action down from the mid-February high at 464.95 as being corrective within the secular bull trend to eventual new highs. That could there could be a 180-degree change in that policy if the market can prove weakness below that 407.60 low, and for as long as the market maintains impulsive behavior down below that level. These issues considered, traders are short to intermediate term traders with tighter risk profiles have been advised to move to a neutral sideline position as a result of the break below the low from 2 weeks ago at 419.20, requiring strength above 424.40 to reject and define a more sound low from which to objectively reestablish a cautious bullish policy. While the market remains below 424.40, further and possibly accelerated losses should not surprise. From a long-term perspective, however, long-term traders remain advised to maintain a bullish policy with a break below 407.60 required for them to move to neutralize all bullish exposure and move to a neutral sideline position in order to circumvent the depths unknown of a larger degree correction or possibly major reversal lower. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.